Hey guys, welcome back to Real Estate Analysis 101. This is Paul Hunter calling, and I just want to let you guys know we're going to be talking about the housing market. Is it going to crash or not? Are we in a bubble or not? Things going on, very interesting. So let's get to it. Housing market hot, but not a bubble, economists say. So let's see what they say. The most popular respondents who buffed the bubble thesis was strong market fundamentals, including demographics, scarce inventory, and shifting housing preferences. Low credit risk as a justification followed due to sound loan underwriting to the overwhelming share of fixed rate, fully amortized mortgages. Another large group of respondents rejected the term bubble, which implies a subsequent crash they do not believe is imminent. Among those who do believe there is a bubble, unaffordable prices is the absence of record low mortgage rates is the chief rationale. To be sure, the housing market is incredibly hot. Home values in April were up 21% over last year, marking the 13th consecutive month of record-breaking annual home value appreciation. Affordability is greatly suffering too, as the astronomical rise in both home prices and rents over the last 2 years coincides with a more recent hike in mortgage rates. However, an extremely hot market does not necessarily mean one in a bubble. Although a recession is looking more and more likely, the housing market today is a far different beast than what we saw in the mid-2000s. Unlike in 2006, this market is underpinned by strong fundamentals and has been built on mortgages with sound credit factors that won't change in the near future. True, but in my opinion, economics equals psychology equals economics. In other words, if we have what we think is going to happen, we end up acting that way and creating something that actually happens that way. It's true that we have high prices, we have low interest rates historically, but people are starting to think that those rates are very high compared to what they're used to. They're used to 2, 3, maybe 4%. The 4 was a little bit high. So 5 and 6 and 7%, like this morning with the Fed doing what they did yesterday, there may be a panic. And so it may not be a bubble right away, but who knows? We'll see. Let's go on. So when will the next recession hit? While the panel largely does not believe the housing market is in a bubble, it does foresee a recession coming soon. The largest portion of the panel, in other words, 45%, expects the next U.S. recession to begin in 2023, which gathered more votes than 2022, which is about 30%, and 2024, 8%, and 2025 and beyond, 17%. Well, we are in a recession. It's just that we don't know yet. It doesn't seem that way. People are still riding the wave. Their prices have not come down in the housing market. The availability of inventory isn't that high either. So people start thinking that we're still riding that wave, but we are already in a recession. The interest rates are already too high for what we said before. The mindset of the people is that that's very high interest rates. So we don't want to go there. And so people end up thinking and acting on what they think, thus creating that situation which we are all afraid of, which is called a recession. This is the really important one. Can the Fed thread the needle? The Federal Reserve is working to strike a balance between twin mandates of reducing rampant inflation and avoiding a recession. Those polled by Zillow are skeptical that this soft landing will be achieved, as 56% of survey respondents do not expect the Fed to materially reduce inflation while averting a recession. The remaining respondents are cleanly split, with half believing that the Fed will be successful in avoiding a recession while reducing inflation. And the other half who are not sure yet. Of those who doubt a soft landing will happen, 3/4 see a recession as the most likely economic outcome. Well, the Fed has changed its policies and its objectives throughout the years, and it has never, ever been able to thread the needle. In other words, reducing inflation, keeping interest rates reasonable, and avoiding a recession. They are always behind the curve. They're always looking at numbers way behind, and they're generating things that are contradictory. In other words, they increase the money supply. That's going to increase inflation. There's too much of something. Remember, the only law that really works in economics, that's really a law, it's called supply and demand. Supply versus demand. There's nothing else. The other stuff is BS. It's just invention of people who go to masters and PhDs in economics. The real objective of the Fed should be to control money supply. But because the government is requiring more and more funds to give for the different programs, different topic, different video. They are trying to do things that are contradictory. In other words, increase the money supply, reduce inflation. That's not going to work. If you have too much of something, it becomes less valuable. So threading the needle is not going to happen. Let's continue, guys. Okay, so home prices, expectations still rising. Despite a more than 100 basis point increase in mortgage rates since the previous survey just 3 months ago, and the potential for higher rates in coming months, the panel's expectations for 2022 home price appreciation still rose 9.3% from 9% last quarter. This would be a significant step down from the 19.6% appreciation observed over 2021 calendar year, but still high above the long-term historical average. Looking forward, the most optimistic quartile of respondents predicted prices would rise 46.1% between now and the end of 2026, while most conservative quartile predicted a cumulative rise of only 9.3%. On average, respondents are forecasting a 26.6% cumulative rise by the end of 2026. Again, guys, home prices are still rising because supply and demand. People are still in the mindset that it's going to rise. So therefore, they are acting on that thought. But once all of these facts, the numbers start to filter into the people's minds and their psychology, we're going to start seeing the results of, well, we're going to see what's really going on, which is a recession. We think we are riding the wave, but we're not. We're actually about to plunge. The psychology behind all of this is once people start to see that the Fed raised the rates 75 basis points yesterday, and what that's going to do to mortgage rates. So people are going to start thinking that, well, first of all, it does cut into the affordability. People can buy less because they have less buying power. If you have to pay more in interest, you can't pay that much more in a house. So that's just the way it's going to go. So the Fed is actually, by doing what they did yesterday, going to trigger a panic. But remember, threading the needle? Not doing that. They should have raised it maybe a year ago, a year and a half ago, and start raising it slowly. They didn't for political reasons. Now, because again, politics are playing a big role in here. When you have 8.6% inflation last month, we're going to have trouble selling that to the public. So we're going to have to cut inflation quickly. What do they do? Raise the interest rates. So again, trigger a panic. What should we do as real estate buyers, sellers, or investors? I still think there are deals to be had, deals to be made. However, the structure is going to be slightly higher. There's going to be less available deals. So that means it's going to be higher priced. You're going to have to invest a little more money in buying the house, in putting it together, fix and flips, and selling it. Or you have to put a little bit more money into buying a house, keeping it for a longer period of time so that the value will actually catch up with the equity you have or that you would like to have in the house. And in the end, talk to a realtor, be focused, be prepared to pay more. And if you're out there buying, selling, or investing in real estate, you got to be good or be careful.